Hello, everybody, and welcome back to Capital Ideas. I'm Nick Morgan, the co-founder of ICAN, Investor Choice Advocates Network, and one of the co-hosts of today's episode of Capital Ideas, where we celebrate innovators and disruptors and the capital markets to bring their ideas to fruition.
I'm Marc Hiraide, Senior Legal Director and Policy Counsel at ICAN.
And I'm Dara Albright. I'm a proud board member of ICAN and a co-host of today's episode. So today, please join us in welcoming Andrew Benson. Andrew is a fintech entrepreneur and founder of Hill.com. That's a venture platform that's reshaping how investors participate in the private markets. Welcome, Andrew. So excited to have you on.
Thank you for having me. It's great to be here.
So let's start with the big picture. Hill.com focuses on democratizing access to today's later stage venture investments, which were essentially yesterday's IPOs. So maybe you could talk a little bit about why this is such a sweet spot for investors.
So over the last 25 years or so, the number of publicly traded companies has cut in half in the United States. It went from about 8,000 to about 4,000. And so the menu of opportunity is shrinking. And part of that has really been driven by the availability of capital in the private markets. So this has allowed companies to stay private longer and grow more valuable in the private markets. And while that sounds like a great thing, and it is for many people who have access, it is leaving people behind because they're being left out. And when we look at this last 25 years, companies used to go from formation to going public in 4 years. And today that's 12. And soon some analysts think it's going to be 16 or 17 as this trend continues. And the average valuation at IPO has proliferated as well. It's got from about 400 million to over 3 billion today. And what we're seeing is founders of some of the best companies out there saying, we have no aspiration to go public. And I think there's many reasons for that. But that's sort of the backdrop. And what we're working on is the ability to provide access for people who otherwise wouldn't have access to these companies that are very late stage today.
So Andrew, with fewer companies going public and investors not having access to earlier stage valuations, how do you see Hill.com helping fill the liquidity and access gap left behind by this shrinking IPO market?
So one of the changes, structural changes that's happened in the world of venture capital over the last 5 years or so has been these large late stage investment funds that are more traditional venture capital. Sometimes they bleed into the investment banking or public market territory, but these folks are going in and they're using their own balance sheet to invest in these private companies. And their whole business essentially is investing in these companies while they're still private, in the very last couple of innings while they're in the private markets, and then holding them into the public market. And so we work with some of those folks who have access to these late stage companies to source those deals. And we create single asset funds that roll up into those opportunities that these institutional investors bring us. And then those single asset funds that we create are available to accredited retail investors in small blocks.
That really is the sweet spot. I mean, it used to be when companies would go public, great deals were done at that $300, $500 million valuation stage, raised 50 million on their IPO. And these were the companies that were, appreciating in the retirement portfolios of, Americans all across the country. Yeah, very, very interesting. How do you guys source deals, and what kind of due diligence do you do to for the deals that you're getting on your platform?
So we typically get the deals from these large institutional investors. So they typically go anywhere from like $100 billion of assets under management up to $1 trillion plus under management. So really large mainstream firms that you're familiar with and would know of are very active in these companies. And the general public, I think, is not quite aware of that. And so we work with them to essentially distribute their investments in these late stage companies to accredited retail investors. So we've built technology that facilitates this in a much more streamlined manner, where we can facilitate all of the payment rails, we can do KYC, all of the compliance, fund administration work as well can all be automated with our platform. So it makes it a great way for these folks to bring on new types of buyers because currently they're going and they're distributing these assets to family offices and RIAs around the world who are taking down bigger tickets. And they want to bring this to retail. It's just been structurally difficult. And so our platform, our technology makes that a lot easier for them to bring it down market without having to deal with all the complexity themselves.
That's great.
So Andrew, here at ICAN, one of the focuses on regulatory impediments to access to capital. Can you address some of the regulatory issues and obstacles that you face in creating a platform for secondary market for shares of privately held companies?
Sure. So one thing we're doing is we're not transferring the shares of the actual company. We are creating a new issuance of a new security, an SPV, or what we call a single asset fund, that essentially you could think of it as like a Delaware LLC. And this Delaware LLC exclusively holds shares in one particular company. So, it could be like, SpaceX common stock. It could be, Anthropic. It could be any of these pre-IPO companies. And so one unit of the SPV is the economic equivalent of one share of the underlying company. And so this is a workaround to essentially deal with a lot of the complexity that comes with transferring the shares. And this also allows us to have these SPVs essentially regulated in a way that would be granted an exemption under the 40 Act as a private fund, essentially. And so the issuance of those shares is not a regulated activity if it's a primary issuance. And then secondary trading within the SPV is a regulated activity. So we're undergoing the process of getting registered as a broker-dealer and an ATS as well to facilitate secondary trading inside of these vehicles. So that's the path that we have to do. That is the part that's very clean and easy. I think the part that's a bit complex here and some of the shortcomings of the 1940 Act are really coming down to the limitations about number of individuals that are allowed to be inside of an SPV or one of these private funds. So if it's a vehicle for accredited investors, you're capped at 99 accredited investors. And if it's a vehicle for qualified purchasers, it's 249. And so essentially that is fine if you want to have high minimums and limit your distribution to individuals that are wealthy enough to write big checks. But essentially these rules do make it hard to go further and further down market. So that is, I think, one of the biggest limitations to bringing the private markets to every household from a regulatory standpoint. So I would say that would be number one. There are some additional complexities as well, but this, I think, is the number one.
It's fortunate that Congress recognizes the difficulty with those limitations under the 40 Act, the 3C1 and 3C7 exemptions. And I think there's been some proposals to expand the number of investors in those vehicles. So we'll see.
Yes. And go ahead. Sorry.
No, you've mentioned the word accredited a number of times, so I've got to ask, because at ICAN we have spoken to on this program, Capital Ideas, a number of people who have been adversely impacted by the accredited investor financial restrictions, the wealth and income restrictions, in a lot of different ways. But I would be interested to hear, so it sounds like you're limiting your activity for the most part to accredited investors, your thoughts on reforming the accredited investor wealth and income restrictions and how that might impact what your model allows.
I think this should be a top priority for the administration to reform this. In a way, it's modern day redlining, essentially, to say that this group of people are allowed to participate in this asset class, but these people are not, and discriminating purely on the basis of how much money you have in your pocket or how much you earn, I think is not a particularly sophisticated way of making that delineation. We are only available for accredited investors today. There are some products that we are considering in the future that might open this up more broadly, whether it's the pre-IPO opportunities that we currently have and just finding a different way to bring this to the market, or some slightly different vehicles that are open to non-accrediteds. But I think fundamentally, one of the challenges with this is that in my view, it's a market is a town square, right? And making an investment is an expression of speech in many ways. It's an expression of an opinion as to the value of a financial asset, or as to the direction of a financial asset. And these rules are intended to protect people from themselves, essentially, which I think is fine in some cases, but there's many better ways that you could delineate as opposed to wealth. I mean, one of these could be a test where you demonstrate some proficiency or knowledge or sophistication in financial markets, and essentially, kind of like how we have driver's licenses, essentially, to demonstrate proficiency before you can go and get in a car and drive. And I think things like that are just very, very obvious, things that we could be doing, or policy changes that could be enacted to bring this more broadly. But I think that even beyond that, I think that it shouldn't necessarily be restricted, based on any sort of qualification, because, these companies are companies that would have been public long, long ago. And so the public-private distinction is very much blurring at the moment.
Yeah, I mean, if you think about it, the public has actually become the exit strategy for the wealthy. I mean, that's
Yes.
basically the system that's been created by not allowing the general public to go in and at these early stages. So it's great. It's great what you're doing. A question on the SPV. So each SPV would count on the actual company's cap table as one investor, correct?
Yes.
So if, let's say, you had reached the limit on how many investors you could have in one SPV, would you be able to then just raise another SPV for, even if it's the same, it's to invest into the same company?
Generally, yes. There may be some limitations on this, and companies certainly have their own restrictions that they have as well. By my estimates, some of these private companies, there's so many nested SPVs. These companies, if you look at the ultimate UBO, you might have tens of thousands or hundreds of thousands of UBOs at the end of the day. And I think that is something that is an artifact from these limitations of, how many people you can have in an SPV or in a private fund. And when we think about these rules as they were written in the 1940s, these are, this was pre-technology, right? This was a world where, you had to send letters to the individual LPs inside of a private fund. Accounting for everything was a bit more difficult and time consuming, and people just didn't have access to information like they do today to inform themselves. So the ability for, an advisor of a fund to provide, information and advice and bespoke responses to members of a private fund were very limited in those days. But today, with technology, with the internet, it really solves that. So I think the limitations as to the number of individuals that are allowed to be in private funds should expand, and track essentially with what technology enables us to do. And I also think this sort of theme is also true as well a bit on the accredited side, which, back in the day, how would you go and study a private company? How would you go and get information about that? Presumably you had to be wealthy enough for wealth advisors to want to talk to you and for you to get enough information to shape your opinions.
Right.
But today, everybody's got the internet. We all have ChatGPT. We all have Twitter or X. We have CNBC. We have all these information sources at our fingertips, 24 hours a day. And so I think that needs to be considered when we see a complete reform of how private markets are regulated, and essentially creation of a new category that sits between public companies and private companies, which, might be like this privately held but traded category.
Yeah, that's interesting. And another way that you could have a solution would be really opening up Reg A plus for, making the rules for Reg A plus more amenable to SPVs. So that way you could let retail come in. That could be interesting as well.
Yes, I think some of the stuff with the Jobs Act, being crowdfunding in particular was in many ways like a great step forward in terms of their openness to providing access to these assets. But I think fundamentally it got a couple things wrong. I think that, it limits how late stage the company can be. It's really just startups and it's primary capital. And when you think about the risk curve, you're letting non-accrediteds invest in what are perhaps the worst assets, most risky assets, where sophistication really is much more necessary to be able to discern whether, some early stage seed stage startup is a good investment or a bad investment. So, I think that is much more akin to lottery tickets than it is a financial asset in many ways. And I think that's sort of been my gripe with with the efforts in the past. It's, they don't quite get it right. And it doesn't seem clear to me that it's really protecting the consumers that it's intended to protect.
That's a great point.
Yeah. Whereas the companies that you're offering accredited investors entree into are a much later stage. They're closer to what we would historically have called a public company.
Exactly. With real institutional capital, real internal controls, and plenty of people to ensure that there is something in the company that's valuable, and they have to price that, right? So you've got real institutional capital behind those companies. And so I think that de-risks retail investors who follow along those large institutions as they participate in these later stage pre-IPO companies. And so fundamentally, I think on the risk curve, there's still plenty of upside in most cases, but a lot of the risk that you would have as it relates to like venture investing is behind the investor. And the upsides in front of them.
Yeah, well beyond the napkin stage.
Exactly. And these are companies that if private markets, if capital in the private markets wasn't so available, they would have been forced to go public, many years ago. And there's plenty of reasons why companies don't want to go public, but these are companies that definitely have the optionality, they have the resources, they just don't want to.
Interesting.
Andrew, I guess one way to look at what you're doing is taking an asset, in this case stock, and offering fractional interests. What are your thoughts on doing the same thing with other forms of assets? Of course, digital assets comes to mind.
That's something we're really excited about. We're starting with pre-IPO company stock because we think that's the most exciting private asset. But we live in a world of financialized capitalism. I mean, that is the modern era that we live in. And so we're looking at other types of alternative assets that could be rolled up into single asset funds and distributed in the same way as the pre-IPO opportunities that we're listing on Hill.com. And so we sort of think about that as, okay, these could be real estate, it could be private REITs. It could be things like cash flowing domain names, right? It could be a company doesn't want to buy a fancy domain name and instead they would just rather rent it. So people will hold that as a syndicate and then get the cash flow, kind of like digital real estate. And I think there's a lot of assets that are not financialized today that very well could be. And this is a testing ground essentially for those assets to come to market and see what the demand is. And so we think about the technology that we're building is it's abstracted enough in a way that it will support all different types of private assets. Could be venture capital funds, LPs who have varying needs for liquidity and may not be able to stay for the whole 10 or 15 year fund cycle. They need liquidity after year 7 for some reason. I could see there being a market for LP stakes of tier 1 venture funds. Retail can come in and buy part of the portfolio. I could see this for hedge funds if they sort of cross over into the private markets and have less liquidity in terms of their total AUM. They have more assets held in side pockets. And there's all types of things, even more traditional private equity funds I see as being something that we list as well. So that's kind of my thesis on the space, and the structure that we're building is going to be the rails to support all of these things.
It's a bit climbing too. I was just with this administration, they have been very aggressive about with the DOL and bringing private equity allowing them into retirement plans. So that's a whole other, area of capital that you guys could tap into. And these are the exact type of products that should be in retirement plans.
Exactly, especially for young people, right? Who have, a long duration, and you can't really touch that money and pull it out without a big tax and penalty in most cases. So, I mean, that's what endowments do. That's what pensions do, who have very long-term theses on their portfolio. And it just makes sense that individuals would have access to the same tooling.
Well, that's maybe we'll leave it there, Andrew. What an exciting vision and an exciting model. We're very happy to hear about your success and wish you more of it in the future. Thank you for coming on Capital Ideas. Dara and Marc, of course, thank you as always for co-hosting. For everybody else, if you want more information about ICAN, go to icanlaw.org, and we'll see you on the next Capital Ideas.